What's going on, kings and queens? It's your boy Fabian Batchelor, and this is Wealth to Live. This week, we're doing a presentation. This presentation is going to be about long-term investing, and every week we're going to be uploading a video about long-term investing as well in the stock market. For me, it's important to understand how to long-term invest. When I first started investing a year ago, I never really had a blueprint or someone to show me each and every step. I was getting information from one person and this person. One person would be talking about cryptocurrency. One person would talk about day trading. One person would talk about Forex. So for me, I wanted to create a blueprint of how I currently invest, and each and every step I feel you should take from investing in a stocks and shares ISA to options, to individual stock positions, to cryptocurrency and commodities. So yeah, I hope you like it. Listen, we're all on the same journey. So if you want, make a comment, anything you want me to talk about or things I should be doing better. But if you like it, press the like button and subscribe. So all right, let's start the presentation. So this week, this presentation is going to be about stocks and shares ISA, the first steps I think you should be taking to long-term investing. And really, I should put step 1.1, because next week is going to be step 1.2, which is dealing with credit and debt, which I think you should be doing simultaneously as you start your long-term investment in stocks and shares ISA. Obviously, there's certain debt that you should get out of the way if you can, like, payday loan debts or certain high interest debts. But if you've got a student loan or, mortgages or low interest credit cards, then you're good to go to for me, in my opinion, to start investing in the stock market. So what's the power of long-term investing? For me, there's three factors: compound interest, generational wealth, and financial freedom. For me, these are the main reasons why we should be thinking about long-term investing and why it's important that we start now. What's compound interest, you might ask? Well, compound interest is also known as the eighth wonder of the world. Compound interest, or compounding interest, is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from the previous period. So in layman terms, your money's making money. Your money's making babies.
That's it.
So every time you invest, not only are you going to make interest on your initial investment, for example, 10 grand, but the interest that it will make, if you make £100 off that 10 grand, if you reinvest that £100, then that's going to make interest as well. So that's the theory behind compound interest. This is an example of compound interest. So in this example I made, if you put an initial deposit of £1,000 and over 30 years, you will put in £6,000 a year, which works out to about £500 a month in deposits. You would, with a 7% return each year, which is fairly modest, because I think, in good years, you could be easily make 15 to 20% return in the stock market. But if you're making just 7%, you could, after 30 years, have 618,102 pounds. So for me, like we say throughout all our videos, it's important to long-term invest, because that's how you're really going to gain wealth. And just imagine if you're in a position where you can put even more money, more than £500 a month. If you doubled it, if you could put £1,000 a month. But don't even let that stop you from investing, because you can just start with just £100 a month. And every time you get a little bit more capital, you increase it. This is just a table of how, over the years, you see how the power of compound interest works. You see in the first year, you have £6,000 gained, deposited, £268 is made, and then you see at the end of it, you have £7,268, and then you just see over the years in the blue column how that compound interest works. So the other factors why I think it's important to long-term invest: financial freedom. Financial freedom is basically the status of having enough income to pay one's living expenses for the rest of one's life without having to be employed or dependent on others. Can you imagine that? That's the aim. Generational wealth. Wealth usually in the form of assets passed down from generation to generation. You know, stock market investment, businesses, properties, bonds, etc., etc. For me, one of the biggest things we can learn from this year is that we don't know what's going to happen. You're going to hear me and Steph talk about this all the time. So that's why long-term investing is so important. It's also a way to plan for the unthinkable. At least you've got a little bit of money. Well, not a little bit of money. At least you have money to fall back on and make moves, and you're not scrambling. So the key points I want to focus on when we're going into for the mindset of long-term investing is, the first one is to execute. We talk about it all the time. You've probably seen thousands of quotes. Without, what's the point having knowledge if you're not going to apply it? So for me, the number one thing is, if you're not too sure, whatever, just to execute, just to do it, just to start. Second point is to always financially think of yourself first. Pay yourself first, or invest in your future first before you pay any other bill. Obviously you have a budget and you'll allocate the correct amount of funds, what you can afford. But when it comes to that, each time of the month, make sure you pay yourself first. Third point, every month, always try to increase how much money you deposit into your investments. If you can increase it by 1% each month to 5%, whatever you can, and you can do the numerous ways of trying to just make more money, or just cutting back on certain expenses. Do you need to buy a certain brand of water? Could you buy, Tesco value water? I'm just saying, like, it's up to you. You can look at ways of making cuts in your life, just as little as your within your shopping budget, to try and put into investing for the future. And for me, the final point, consistency, also known as dollar cost averaging, which is just basically, you can't time the market, but having time in the market, your returns will average out. So if you consistently put money into the stock market over average period of time, you should, in theory, make money, as long as you're putting it in sound positions or positions with good fundamentals. So why the stocks and shares ISA, you might ask? Why make that the first step? Now, the first point I want to say is that with a stocks and shares ISA, you can invest up to 20 grand free from capital gains. So no tax on profit when you sell an asset, and on income tax. That's also bearing in mind that if you've got any other ISA accounts, you've got to think about them. So if you have 5 grand in a lifetime ISA, then you can only invest 15 grand in your stocks and shares ISA. But ultimately, you're not getting taxed on any of the returns. So it's a no-brainer. And remember, it's not how much money you make, it's about how much money you keep. So tax is a big thing we should be thinking about, because ultimately, paying less tax is a way a lot of people, you see it all the time, a lot of rich people, a lot of rich companies make money by paying less tax, because it's not tax evasion, it's tax avoidance. Tax evasion is you're not paying tax at all, but tax avoidance is a legal way of reducing your tax payment. So that's another thing we've got to think about. Also, it eases you into the stock market, stocks and shares, because what you find, you're going to be most of the time investing in ETFs or indexes. So imagine an index as a supermarket and an ETF as an aisle where you're going to be buying certain products. So these are usually groups of stocks in one fund. So you're getting exposure to a lot of things with less risk. So that's another thing we should be thinking about. And it's a way, like I said before on the previous slide, of practicing the art of dollar cost averaging. So for me, this is the company or the asset management firm, I recommend Vanguard. First and foremost, their charges and fees are low. When I first started investing in stocks and shares, or in a stocks and shares eyes, I was using Moneybox, and they were charging like, when I worked it out, it was just over 1%. Now it sounds like nothing, but when you think about it, if you're looking to make a minimum of 7%, and someone's taking 1%, that's 6%. Now if we get to that place where we're investing like 100 grand a year, and someone's taking 1%, if my math's correct, that's about £1,000.
Correct.
Whereas Vanguard, most of their funds average to around, charges and fees about 0.27. So if we go back to the 100 grand example, that's like £270. That's a big difference. So that's another thing what I like about Vanguard. Their fees are very low. They have good funds. The funds I'm invested in, one of them is the VUSA, which tracks the S&P 500. So ultimately, the top 500 companies in the US is tracking that, and it's mimicking the same performance as the S&P 500. Third thing, it's the second biggest asset management fund in the world. It manages around 6.2 trillion. Now, why is that an important thing? You got to think about it. If you're looking to long-term invest, and like I gave you examples before, over 30 years, you're going to have a lot of money in that account. And a lot of institutions and banks are only covered up to 85,000. So you want a company that is basically reliable and trustworthy. And any company can crash, but are less likely to. So that's another factor, I think about. And the fourth one, their founder, Jack Bogle, he was credited for creating the first index fund. He preached long-term patience over short-term action. And through his company, Vanguard, he saw brokerage fees reduce. So this company was built on what we're trying to do or save or run away from, fees and charges. That's what they're about. So when it comes to long-term investing in stocks and shares, ISA with Vanguard, a big thing is how to create your portfolio. And for me, this is an individual process. Depending on, what amount of capital you got to allocate to a particular class, and, it depends on the individual, on your risk tolerance, your age, your situation. Everyone's circumstances are different. So when it comes to creating your portfolio, you got to think about yourself and your risk appetite. But from reading, there's two big investors that I like to show you what they say. They recommend how you should structure your portfolio. So David Swanson, who is a Yale University endowment manager, in the space of 35 years, he turned Yale's endowment from 1 billion to 30 billion. He recommends that your portfolio should be made up of 20% US stocks, 20% international stocks, e.g., UK, Australia, or China, because you got to remember, when they talk about international, it's anything out of other than America. Emerging stock markets, 10%, e.g. India, Brazil, South Africa. REIT, which basically is real estate investment trust, 20%, and 30% bonds. Another superstar investor or master investor in the game is Ray Dalio, who advises countries, big countries. America will take his advisory about how they should allocate their funds and their trust funds, and so many countries around the world. And he is one of the richest men in the world. He recommends that you should have 30% stocks regardless of what they're in. And bonds make up 55% of your portfolio. Gold should make up 7.5% of your portfolio, and so should commodities. Now, I'm a person that I like to listen to people that are doing stuff, and are doing what they're trying to tell me what to do. So I thought, let me share, how I'm investing my money and what my portfolio is made up of. So my portfolio is made up of 70% US stocks, 15% UK stocks, and 15% emerging markets. Now, the reason why I've gone so heavy in stocks is because I'm still at a relatively young age, so you know I can be pretty aggressive, and I like taking risk. You know, so that's why I've gone with US stocks. Also, in some of the examples, you'll see international stocks. But the way I see it, if you're investing in the top 500 companies in the US, most of them are global. So you're going to get some exposure to some country that they're in. You know, you see McDonald's everywhere in the world. So, you know, you're getting that global exposure anyway to a degree. And the reason why I don't really have bonds or any commodities is because bonds to me is just debt, you know, however you look at it. So I want to invest in things that are, you know, a company that is thriving and can grow, has some growth value. And things like gold and other commodities, you know, I'm not too keen on. I mean, they say it was a hedge before, but we've seen that gold can be just as volatile in times when stocks are low as well. So it's that's why a lot of people are going to, you know, cryptocurrency as a hedge now. Now, one of the biggest things when you've got a portfolio and you're investing and you start seeing your returns is understanding that you need to rebalance your portfolio. Once a year, you must rebalance your portfolio by selling assets that have taken too much percentage of your portfolio than you plan for, and buy assets that percentage in your portfolio have decreased. So, for example, if you plan to only have 50% of your capital in US stocks and 50% of your capital in bonds, but after a year, US stocks increased and now it weighs 60% of your portfolio and bonds now make up 40% of your portfolio, to make sure your account continues to grow or stay the course that you planned, you need to sell 10% of your US stocks and reinvest it into bonds or another asset class. So ultimately, it helps you diverse your portfolio, because you don't want one asset class to grow too high and then the other one that you plan to have a certain percentage go too low. So you need to resell so that you rebalance it, and you it actually saves you having too much risk. Also, that's what you see in the stock market certain times when there's dips, because certain hedge funds pull out of positions that have just run up high and they sell a percentage of shares and then the shares just dip. That's because they're rebalancing their portfolio. And it's just, it makes sense. If you've got something that's run up high, you sell it and then you buy something that's still low. It's another way of just rebalancing. So I recommend to anyone that once you start getting into investing and, you know, you get used to it, you research the power of rebalancing. So for me, when I started my investment journey or investing in the stock market long term, these were three key books to me, you know. You might have your own, definitely send comments and share your own. But for me, these were fundamental books that got me on the course to long-term investing. The first one was Rich Dad Poor Dad by Robert Kiyosaki. Basically, I'm going to summarize that book. He was basically giving you the mindset of assets over liabilities. Make your assets pay for your liabilities. I actually read that book on a PDF online, so I'm going to try add that to the link in this video. But I definitely recommend starting from there. This is the order I started, read them through. So I recommend going through this order. The second book is Simple Wealth, Inevitable Wealth by Nick Murray. This is such a great read. It's such an easy read. It's only 180 pages long. Yeah, let me show you Frankie's. I forgot. You know, I'm in cinema.
It's right there.
Good, but I'll bring it for you. This book basically breaks down the fact that by not investing in the stock market is the biggest mistake you can make. You know, it's basically about owning stocks. Don't matter how you look at it or however you enter, whatever you're listening to, it's just about owning stocks. And he just breaks that down in layman terms. The third book is Money Master the Game.
Jeez.
By Tony Robbins. For me, this is the ultimate guide to long-term investing. In this book, he breaks down ETFs, indexes, pensions, life insurance, all of the things you need to long-term invest. So those are the three must-read books. So that's it. That's the end of my presentation. I hope you liked it. Here at Wealth to Live, we are just dedicated to providing knowledge of investing and how to build assets with the aim to create generational wealth in the community. So, I hope you enjoyed the presentation. And the last question I want to leave you with is ask yourself, why do you want to build wealth? What are you doing this for? Because ultimately, that's what's going to help you drive forward and, make this money, make this guap. So definitely subscribe, follow us on Instagram and follow us on Twitter.